So the biggest tech companies on this planet losing $3 trillion in market capitalization. The question is, what will be the domino effect here in India? We've already talked about the winter season. We've heard about thousands and thousands losing their jobs. We've heard about the markdowns and how unicorns will also be losing that precious tag. What's in store for us? Remember, a lot of the startups that raised big bucks in 2020, 2021 were burning that cash by actually giving it to Google and Facebook to onboard customers. You've just heard how ad revenue growth is the slowest since 2013. Let's talk about this and more with our panel. Joining us now is Nimesh Kampani, tech investor, as well as Siddharth Pai, founding partner of 314 Capital. Thank you, gentlemen, for being a part of this show. Siddharth, I'll come to you first. You've been talking about this since February, right? That how when interest rates go up, what happened to the US dollar, the impact that we're likely to see in India. The question I want to ask you now is, if you're seeing this on the Wall Street, does that mean we've not seen the worst yet in India, whether it's markdowns, whether it's job losses, or just the lack of funding?
So, Nata, that's actually a fantastic question. And this just goes to show that even the resilient startup industry ecosystem across the entire world isn't actually immune to the vagaries of the macro markets, especially with the interest rate changes that we've actually seen so far. So the Indian startup ecosystem was actually birthed during an era of fairly low interest rates right now. And this is the first time when generations of entrepreneurs are actually seeing the changes in valuations occur because of a change in interest rates that's actually going on so far. With regard to the Indian startup ecosystem in particular, India is actually one of the bright spots that still actually exists in the entire world market as well. Investors turn very, very bullish when it actually comes to Europe right about now because of the number of issues that they have. And the US as well, most of them have actually seen most of their larger growth tech stocks actually end up stagnating. The US has also seen a couple of quarters of stagnating growth, actually rising fears of a recession that the White House actually had to correct as part of that also. But Indian startups are surprisingly seeing a large amount of activity happen. Frugality has now become the mainstay for a number of them as well. The earlier model that was in vogue of actually raise as much money as you can, or raise and burn as much of that money as possible, has been completely thrown out. A new playbook's been written right now where stronger fundamentals and frugality have actually become the go words for everyone going forward. And the surprising thing about this, Nayata, despite actually historic lack of activity in the Indian startup ecosystem, we've actually seen Indian funds and India-focused funds raise their largest fund sizes during the last year itself. So there's a large amount of dry powder that's actually existing on the sidelines right now. I think all investors see 2022 as a washout year. 2023 should actually see some amount of optimism happen by the second quarter onwards. And most of them will be actually looking at startups who manage to actually get out of this particular valley of death that we're seeing right now, emerge a lot stronger. These are the guys who will be able to attract the largest amount of capital that Indian startups have been able to see in the past. So I think it is actually dark right now, but I think the silver lining is actually apparent for everyone that's there. We just need to be patient for a couple of more quarters for that to end up coming to fruition.
So let's talk about this more with Nimesh Kampani. Nimesh, today I was looking at the stock prices, and Nykaa, which is down over 7% in today's trading session, almost the same price now as a Paytm. Around the world, we've seen how all of these fintech stocks, new age companies are under pressure. Multiples that have also come down. What are you anticipating when we talk about the listed players? Bloodbath?
So, Nayata, I think today is maybe a one-off because I think the lock-in is coming to an end around 10th of November for Nykaa. Maybe that's the reason. But I think overall, I think let's just go back. And I think just to summarize what Siddharth said in one line is normalization in common sales prevails now. Right? I think he hit the right spot in terms of what was happening and what should happen. But I think we should also not forget that what happened last year is largely also a COVID impact, right? And if you see amongst the listed players as well, our traditional businesses, financial services businesses, all of those had taken a hit in some manner because of COVID, right? And the only businesses that were growing were the tech businesses. And that's why I think you saw the run up in the tech stocks when it came to the listed market. And I think one thing which I strongly believe in, and if you just go back in time, maybe 1 year back to what each of the founders of these IPO-led companies had said, the valuation they actually got was multiple X of what they had said is the right value of the company. So founders always knows the right value of the company, and Siddharth knows this very well. But I think last year was largely driven by liquidity, lower interest rates, and lack of choice. So I think all of those factors came into fore when we saw the kind of valuation these companies were getting. And I think now is the time when normalization prevails, superior business models will prevail. I think the proof of the pudding is, are we building a sustainable business which is generating cash, or are we just burning cash? And that is where the differentiators are coming out. So I think for the tech stocks which are listed in India and which are going to list in India, of course, the long term, I'm bullish on India. I think that's where the growth in the tech ecosystem will come from. A lot of innovation happening, a lot of new things happening. So it's a long-term game. I think we discussed it in the past as well, right? You can't expect returns in 1 or 2 years because there are a lot of things that keep on happening in startup. But I think, yes, maybe it may be the right time to look at evaluating whether you want to invest in these or not. Right?
So Nimesh Kampani, let me put it to you as crudely as I can. I think we might see a re-rating of PE multiples globally, right? It's maybe starting from the NASDAQ, but it looks like that's going to have a cascading impact. What would you do if you owned these fintech stocks? What would you do if, in 2023, you would also see IPOs of these new age companies?
So as I said, I think a long-term investor will continue to invest, because you should also remember these are high beta stocks, right? When the market is in a good bull run, I think these will perform much better. Today, I think it's some amount of the basket of investment is moving towards traditional stocks, moving towards financial stocks, moving towards services. And that's why I think you are seeing some amount of sell-off in these stocks. But eventually, I think once they start showing the right numbers, showing the right path of profitability and growth, you would see them coming back to the stock prices will, of course, follow the growth that the businesses show fundamentally. And of course, cannot continue to expect, and that is what the street was expecting earlier, is that they'll give you 50% quarter-on-quarter growth. That cannot last forever, right? It can be 1 quarter, it can be 2 quarters, it can be a year. But normalization does take place, and that, of course, brings down your PE multiples and your valuations. So I think that is what you should expect in these companies.
So Siddharth, we talked about Meta down over 20%, Microsoft, as well as Alphabet that had crashed over 8%. Let's not forget Amazon. Its extended 12% stock rout led to $140 billion of market cap being wiped out. That's more than the entire enterprise valuation of what? A Netflix, a Morgan Stanley, a Lockheed Martin. But the question now also is, with what Alphabet has spoken about, the slow ad growth rate, startups that were relying on, let's say, YouTube. I'm guessing profit sharing models could change by Alphabet. Startups that were relying on, let's say, Instagram for, making themselves popular, onboarding customers, that could also change. Do you think the Indian startup ecosystem is now ready for new marketing tools, for new ways to onboard customers? Because all of that is going to change.
No, that's true. Actually, so Mehta, you actually hit the nail on the head when you said that a large chunk of the capital raised by Indian startups has actually gone to the coffers of a Google, a Facebook, and all these particular people as well. I think over this entire year, a number of startups have actually relooked at their marketing budgets right now, and they've actually decided to inject a larger degree of frugality. There has been a number, I think you guys have actually covered a few stories where some of the founders have actually cut their marketing budgets down by anywhere between 40 to 80%. And they haven't seen the same reduction when it actually comes to the new user onboarding, the churn rates that they've had, etc. So I think frugality, scarcity breeds innovation. When all these startups have also started off, a number of them didn't have access to the large amounts of capital that they have in their Series C's, their Series D, everything like that. So for a number of them, this is actually taking them back to the early days of actually starting off being a scrappy entrepreneur. And I think a number of boardrooms entrepreneurs are actually relishing the new kind of challenges that actually come out so far. Everyone knew for a fact that this large unlimited pool of capital was something that would actually end up going away, as I said previously. Now, the smarter companies and the smarter boards have actually prepared for this day. They managed to raise money when times were actually good, and they've been very judicious in terms of their capital allocation that's happened thereafter. I think the startups that are going to suffer right now the most have actually been ones who truly believe that these good times will actually continue for indefinitely for that matter, and didn't take adequate steps to actually prepare for the eventual downturn that everyone's actually waiting for. So I think we are seeing the entire playbook of the Indian startup ecosystem being rewritten right now. The older playbook of move fast, break things has actually been thrown out. I think we've actually broken everything that could possibly be broken. Now is actually the time for everyone to piece things back together, come up with the most sustainable model, and to go back to first principles and fundamentals itself. And I think that's been a refreshing change in startup ecosystem, and it's actually a sign of maturity of it also.
Frugality and return to first principles needs to be the theme of these times. Now, Nimesh Kampani, it's always great talking to you because you understand public markets, private markets, and how they intersect. For the benefit of our viewers, Nimesh Kampani has been with Kotak. He was in investment banking. Then he set up Trika, which is of course under Let's Ventures. That's how he gets private markets. So when we intersect the two, and this question is for HNIs, all of those that dabble in equity markets as well as the private markets. We bottomed out. This could also be an opportunity maybe to accumulate positions or to just get good value at a good price.
Yeah, so Nanda, I think this is actually the time for investors to get into the growth startups. As Siddharth was mentioning, right, we have to build sustainable businesses. And the ones that can see through these times are the companies will do very well when the good times are back. And times will, of course, change. So if I were an investor, I think this is the time when I will look at companies in growth stage. I look at deploying capital there. That can be pre-IPO, maybe 3-4 years away from IPO. But I think that's the segment I will look at investing today, because these are the guys, these are the entrepreneurs, these are the founders who have seen through tough times. Right? And that's actually the time when you see who can stand up and who drowns in these entrepreneurial journeys, and we've seen a lot of those happening as well. So I would be an investor, right value for you to get in. And I'm seeing that happening a lot across the family offices and HNI segment. People are looking at investing, taking bets. A lot of people are doing liquidation events at deep discounts. So you are getting value, right? Even in listed, you are getting value. So it's the time for you to write the check, right? And wait for 3 years, you will see the results.
Okay, so hang on tight, wait for the results. As you've said, yes, you cannot be completely decoupled and isolated from the rest of the world, but we have seen our startup ecosystem show some resilience. Let's see how resilient it will be. Only time will tell. Thank you, gentlemen, for joining us today on Startup Central.